independent. And the big one is the objectivity, the integrity of management. So this is before you accept them as a client. You do this. So are you qualified to do it? Legal, ethical requirements, and integrity of management. You're required to contact the successor auditor, or excuse me, the predecessor auditor if you can. You know, assuming they're not dead or left the country or whatever. If you can do it, basically, you're required to. And just get, and the big thing is to give, so that you are sure that you can complete the audit, and second of all, that you that management has integrity and so forth, that you want to take them on the client. And I think I talked about the yeah, I think I'm almost positive I did the thing about beginning inventory can't be verified. Okay, yeah, that's where we ended up. Okay, so preliminary engagement activities. So this is when you actually decide to take them as a client. If you decide not to take them, you're not going to do any of these, you know, preliminary activities. You know, for instance, the audit team. You're not going to get an audit team together if you're not going to take the audit. Let me see something. Oh, it's not supposed to do this. I thought I got rid of that. It's so irritating. It keeps returning. All right, let me do something here. I had it fixed. Let's start the dog. That's what I'm gonna do. Doggy. All right, so let's see here. I'm gonna go to share screen. Back here. Okay. If I seem a little disheveled, I have a student that is stuck in Myanmar. They had a military coup. It's like, you know, you think you have problems and you realize you don't. You know, so that's what we're trying to deal with, to figure out what to do. Okay, so the audit team, this is basically the people on the audit team, and you're generally going to have IT people on the team. And specialists, the specialists that you would have, I don't think I went over this before, but they're specialists. For example, the big ones you have are actuaries for pensions and healthcare. And here's one that's a little bit strange that may not seem appropriate, but it actually is, and it's commonly used. Oftentimes you'll use the client's actuaries. It's one of the unusual cases in which you are you could very well be using the actuaries used by the client, and the reason why is because these are huge dollars, huge numbers, huge statistics, and bringing someone else in to redo all that work would be prohibitively expensive. And generally, actuaries are also similar to auditors in that the whole thing is you're not biased. So even though you're paid by the client, you're generally not biased. So a lot of times we will use the actuaries that are the client's actuaries. Simply because they have done all the work, they're the ones that have, and similar to like what auditors would do. They're the ones that have deemed what is correct for those for the things that they need actuaries for. One that comes up a lot is gemologist. I'm probably spelling that wrong. Could be other specialists too. Anyone who's an expert in something. For instance, if you have a lot of real estate holdings, maybe you want someone who's a real estate expert, that sort of thing. But gemologist, for instance, if you're auditing a store that has jewelry, I can't look at a ring or a diamond or whatever. I have no idea what the value of it is. And they have all kinds of grading of diamonds and all this kind of stuff. And the thing is, you could really have a change in income significantly just by not knowing which, what it's worth. A 1 carat diamond could be worth $1,000 or $20,000. So it depends. So specialists are one of the things that you have to line up, and that is one of the considerations you have to do when you're taking an audit, is to know what specialists you need. IT people are virtually always there, unless it's a very small place. But usually the IT people are the ones that will go through the computer systems, and they do some other stuff too. A lot of times they'll do the analytical procedures be done by the IT department. Okay. Understanding with the client. And this is sort of a meeting of the minds. Basically meetings of the mind. In other words, that the two groups will have to have an understanding to have a valid contract. And basically an engagement letter is a unilateral contract. And what we mean by that, a unilateral contract is a contract where if someone does something, they get paid, but the responsibility is on the person to do the act. So as auditors, are responsible to do the audit, and then we will get paid for the audit. So it's a unilateral contract. It isn't like we give them money and they give us a car, where it's bilateral. It's on two people. It's basically a unilateral contract where if we do the audit, we're supposed to get paid. So it's the burden is on us to actually do the audit. So that's why it's called a unilateral contract. Okay, so what's in the engagement letter? Some of the stuff is pretty standard, what you would expect. Auditor service to be performed, usually it could be an audit. If it's a publicly traded company, be audit of financial statements and audit of internal control. Excuse me. That topic just bored me for a second there. Okay, the auditor's responsibility. Our responsibility is to follow generally accepted auditing standards, either by the US standards or international standards. And C is probably the most important of them. Limitations of the audit. Materiality. Now, we never tell the client what materiality is. There's actually an exception to that. I'll tell you in a second. So we never tell the client the auditor's materiality assessment. We do not tell them that. Remember on the exam, the one question where the client wanted all the working papers so they could go show the bank and tell them that everything's 100% correct. A couple things wrong with that. You never say that the financial statements are 100% correct. You don't want them telling the bank that's not what the audit says. But also, you never give them the entire working papers. If there's something that they need, you can give it to them. For example, if accounts receivable is misstated, they may want the paperwork on that. So, okay, well, which accounts are misstated so that they can make the correction. There's nothing wrong with that if it's specific to an account and that sort of thing. But you never give them the entire working papers. You don't. First of all, there's things in there that they shouldn't see. They're your evaluations of them and so forth. But also materiality. You don't want them knowing what your materiality is. If they know that you're not going to, that your materiality is 500,000. What's going to stop them from making, bumping the books up by 400,000? Whereas if they don't know, it's better because then they would, at least not. At least there's a possibility that you could either get caught or not do it at all. They know it's 400,000 and not 4,000, might make a difference. So you never tell the client about the materiality. That's your own, but you will say generally that you only look for things that are material. And if they ask you how much is that, to say, well, it's, we have our own things, our own ways of coming up with that. You tell me you get reasonable assurance, not absolute assurance. By the way, materiality, one of the things you also tell them is that you don't look for things that aren't material. If there's a fraud that's not material or an illegal act that's not material, you're not going to look for it. If you don't look for it, probably not going to find it. You might, but it's not what you're looking for. Okay. Inherent limitations of internal control. In other words, there are limitations of internal control, no matter how well they're made and all that kind of stuff, that you cannot. Actually, I think that there are limitations to it. That it's not absolute. But you're going to tell them that management's responsibilities, and the big ones are these two. But also, and this is one that a lot of times clients don't. If they've never been audited, a lot of times they have problems with this one, and that is provide the auditors with access to all relevant information. There are some people that are, I worked with a guy that used to do audits of smaller companies. It was kind of funny. He said that they would always be shocked when he asked for their tax forms or, their banking account. He thought that, they thought that they were, they had no idea that you're going to ask for bank accounts and tax returns, things that directly apply to the financial statements that they weren't aware of. So one of the things is making sure that they know, look, we need to get all the information we need to form an opinion. I may want to mention to them there's a document retention. And we talked about this before. AICPA is 5 years, PCOB is 7 years. This one is an important one, and that is that the financial statements will agree with other management documents. And that means, one of the ones that commonly means is a company will put out an annual report. Every year, a company puts out an annual report. So we have those financial statements in the annual report. The financial statements are made by management. And then the auditors, will put an audit report in there based on the financial statements. And if it's publicly traded, they'll put something in there on the internal control, a report on internal control. Now, so let's say that you did an audit of the company and you come up that their sales are 520 million. Okay. All right, very good. So for instance, you know, they have I forget what I said. Their sales are 520 million. Okay, so you're reading their annual report and they talk about sales of 600 million. In other words, what they have in their annual report doesn't match up with the financial statements that are also in that annual report. So the question is, what do you do with that? There's some different remedies you do with that. But one thing that you tell them right up front with the letter is that, look, all your information that you put out must match what's in the financial. You know, you can't change what the financial statements in a different kind of document reporting. Okay.
Is that another way of telling them they can't have two sets of books?
They can't have two sets of books unless they're a governmental agency. Then they're required to have two sets of books, which is kind of strange. But yeah, but yeah. So they would. But it does come up sometimes that they'll have something in the annual report, for instance, that doesn't match what's in the. A lot of times they'll put ratios in them, and it's notorious that some companies will have ratios that are not really, you know, how they came up with them is suspect, because they don't match up with the financial statements. But yeah, so.
I mean, these technology and internet companies like non-GAAP metrics of performance that, you know, like clicks and eyeballs and growth and anything but profits, because they're not profitable yet. So
yeah, right. Yeah, and there's a lot of stuff that they'll have in there that you know, may not reflect it, but also sometimes they'll put stuff that in there that is just, you know, not right. And by the way, that one of the things that is also true about GAAP is there's a lot of companies will say, you know, look, our business is way different than most businesses, so, you know, we think it should be applied this way. Sometimes they get variances basically from the SEC on how to report stuff. But again, whatever you have in that report, or whatever it has in the financial statements the report is on, those should be reflected in all the materials that management gives. One of the things you do tell them, though, is a timetable, and a lot of times, you know, you come up right up front with it and tell them, look, you know, we have to take an audit of the inventory, for instance. You know, account of the inventory at year end. So when you guys doing your inventory, we'll have to coordinate when we do that, when it starts, when it ends, what would you, how many people you're going to have, and all that kind of stuff. And those are important, because, and now notice that you never tell them what you're actually going to do. You never tell them, for instance, specific tests you're going to do. You don't say what kind of procedure you're going to do or anything like that. You never tell them the procedures. But there are things that they need to know, and that's a timetable, for instance, of when you're going to be there, you know, when they're going to do their ending inventory and that sort of thing. Those are all things that they have to know. But you never tell them. Let me put this in here. Yeah. So you never tell them about specific procedures, what you're going to do, when you're going to do them, all that sort of thing. But a timetable is important. And the timetable too, if you could, and here's where this might come into some of the specific procedures, but you're not really going to tell them exactly what you're going to do, is you might want to do some things at interim dates. I don't know, I can't remember if I talked about this or not, but interim dates means during the year. You know, at the end of the year, everything is crazy, and you're trying to get this audit done, and you have people working in crazy hours and all that kind of stuff. Well, if you think about it, if they're a company that has sales throughout the year, well, you could actually do an audit and do some of the audit procedures for the sales, say January through October, there's no reason why you couldn't go in November and, you know, do an audit of some of those. And if the controls are okay, you can, you know, usually get away with that. And so a lot of times there's things you can do ahead of time, and that is also in this timetable. Like, look, if, you know, we'll come in and do this ahead of time. There'll be less stress on you guys, less stress on us, and all this kind of stuff. So those things are also, you know, in there in the timetable. Okay. Any questions? Okay, use of internal auditors. I was an internal auditor and I worked with the external auditors quite a bit. Objectivity, usually this is where in the organization they report to. Where they exist. And the internal audit department, you know, here's a company, and they have president, and they have all these departments going down. So this is you know, president, yeah, maybe CEOs here somewhere, depends on where they are. But anyway, now ideally the internal audit department should be over here somewhere. They kind of float around outside. And up here you have board of directors. And audit committee. You have to put an extra M in there. But anyway, so it's sort of like this is inside the company. And ideally, the internal auditors report to the audit committee. They may report to other people too, and they usually do, but they should report to it. And so what will happen is, if something happens in, you know, here's the sales office in Dubuque, Iowa. So the auditors go down, they look at it, and give a report, and the report will go to the people it needs to go to. So here's the Dubuque, Iowa, the sales office. Oops, let's see. They go down, they do their audit, they come back, they give the report to the CEO, and whoever, you know, whoever's in charge of the Dubuque, whatever. But ideally, this is how it kind of goes. And the companies I worked at, we did this. We'd always copy everything to the audit committee. Where I was at, we'd also send the report to the CPAs. So when we made an audit report on anything, you know, we'd send it to the board of directors, we'd send it to all people that they know. And we'd also, kind of as a courtesy, send it to the CPAs. They look, by the way, this is what we came up with for this, just so that they are aware of it. So that's not uncommon. Now, using the internal auditors, CPAs kind of can, a lot of times they'll rely heavily on, depending on the company. Why? Because they can spend, you know, 6 weeks down in Dubuque, Iowa, figuring out what's going on down there. You know, the CPAs have 4 weeks to do the entire audit. They can't spend 6 weeks in Dubuque, you know, so they get a lot of information from the internal audit if they can, if they can, they would prefer to do that. Oops, one thing. Okay, so objectivity. So, you know, this is kind of where they report to. Competence, are they competent? They know what they're doing. This could be certifications. Training, etc. And internal control is, these two are kind of related, and that quality control is that they would actually go and make sure that the quality of the audits and so forth is up to standards. So this is a review, some reviews of procedures, and so forth. And these two kind of go together. So these are kind of on the audit, the internal audit department themselves. This one, a lot of times, is simply where are they in the organization, and if they're reporting not to the board of directors but to the chief financial officer or something like that, you might not rely on them as heavily. But you generally, to some extent, you want to rely on their works if possible. Because they have a lot more time to do it. It's not that they're any smarter or anything like that. They have more time to do it. You can actually have internal auditors doing testing and that sort of thing. They can't make decisions. They can't make any judgment calls, but you can actually have them do audit procedures. And I used to do a lot of them. Okay, and communications with the audit committee and the board of directors. There are things that you must communicate to the board of directors and the audit committee, and it's good to put that right in the engagement letter to let them know that, look, we find problems, the audit committee and the board of directors are going to know. And the audit committee should be the ones that actually obtain the auditors and work out the compensation. So that is actually, if they have an audit committee, if it's publicly traded, they have to. If they're not publicly traded, oh yeah, and an article I was going to give you guys. It's about people, a lot of things in business now. They're making, basically trying to weasel out of having SEC look over their shoulder. So they're doing things to avoid. Anyway, I'll send you a thing on it maybe next week. But anyway, what was I talking about? I hate myself. I just interrupted myself. Gotta look at my notes. There we go. Oh, audit committee. I remember. Remember, I was there. You were there. No, the audit committee is. They're the ones that should hire the auditors. They should work out how much they get paid. Work out what actual things that they're going to perform. They should approve, especially if they're issuers, if they're publicly traded, approve any work that's done by the CPAs. So the audit committee is, it's very important in that they are, they're the ones that are actually going to be dealing with the auditors. So, as far as external auditors are concerned, the audit committee is, the oversight. And so when you come up with something and you let management know that, look, if we come up with something that's material, it's going to the audit committee and the board of directors. It is required that we do that. So, okay. Okay. Audit strategy and plan. So a really big thing, and that is to assess audit risks. So assessing audit risks is actually a very important aspect of doing the audit. You look at what could possibly go wrong. And notice that a lot of this is going to be dependent on accounts. For instance, the supplies account is probably not nearly as important as, say, the inventory account. If you have cleaning supplies, it might be immaterial. The entire account might be immaterial. So even if that thing was 100% off, you probably wouldn't care. So, assessing the risk, you always look at the dollar amounts and things like that of individual accounts. Some things are more likely to are riskier. If it's cash, somebody would want to steal cash. Everybody would want to steal cash. If it is a industrial washing machine that's 13 feet high and weighs 70 tons, who in their right mind would try to steal that? So there are different risks of different accounts and different items and that sort of thing. Analytical procedures, I think we talked about that already. Analytical procedures generally point you in the right direction. They are usually not evidence in of themselves. There's a couple of things that they can be used for evidence, but generally not. Okay, risk assessment. We always talk about dollar amounts and probability. Okay, so let's say risk A. Dollar amount of risk A is $1 million. Center it a little bit better. Okay. And the dollar amount of risk B is $100,000. Probability of risk A is 0.01. Probability of risk B is, let's say, 20%. Which one of these is a bigger risk to the company, to the auditor? Well, you're going to multiply them. This will give you the expected amounts. One % of a million is, I think, 10,000. You may want to check that. And 20% of this is 20,000. So risk B has the higher expected possible misstatement, possible amount of risk. Also, notice it's more likely to happen. So not only is it bigger, it's more likely to happen. So we're not just looking at the dollar amount. The probability of it happening is also very important because this determines basically what we'd expect to have an average of a, of a loss or of a risk, but also, what's the likelihood of it happening? Well, this one is right in there. This could happen. This is fairly remote. 1% chance is probably not that big of a deal. It's very unlikely. Whereas this is certainly in the possibility that's going to happen. I mean, it certainly is somewhat likely that it could happen. So you always have these two different aspects to any risk: the dollar amount and the probability. And the probability isn't just to get the expected amount, but also how likely is this going to happen? This is, I don't say, I'll say somewhat likely. Whereas this is unlikely. This is 20 times more likely to happen than this one. Put it that way. Okay, this one we have to cut and paste. I did not put nearly enough stuff in this established materiality for us to use. So if you pull up, I gotta stop sharing. I think there's a way for me to share the entire screen. Oh, here we go. Ooh. It's almost sad that I just realized that. Okay, so here we got our establishment. So we're going to get rid of this stuff here. I'm going to cut and paste this into. You can also just do it separately if you want to leave it. I just wanted to have it complete in one spot. So I'm going to paste it here. So this is our new and vastly improved established materiality. And that's that second handout that they sent out, like that. You can also do it separately. You can actually do quite a bit on materiality. There's a lot in there. Okay. So I think we talked about a little bit about this before. Materiality, we have rules of thumb. And these are basically, how do you know what is material? By the way, this is for the dollar amounts. These are quantitative. And this is what we mostly think of when we think of materiality. Is what is the dollar amounts? What are the dollar amount of the truth? 500,000, 5 million, what is it in terms of dollars? And these are some rules of thumb. Did I give you guys an example of these? I can't remember if I did or not. I think I did. But these are kind of just rules of thumb that you'd have for materiality. And these come right out of the book. The only one I'm a little bit confused on is this one. They have net assets and total equity, which are exactly the same thing, unless they're talking about tangible assets or net long-term assets. I'm not sure, but they say net assets and total equity, so I'm not sure what the distinction is there. But it could be tangible assets. It could also be, long-term assets. I'm not sure, but they give a little more leeway there. So. But usually net assets and equity are exactly the same thing. Okay. So these are kind of rules of thumb that they would have, and these are percentages. So for instance, income before tax, before income taxes, sometimes called IBIT. You'll see that sometimes called IBIT. Finance people always call it IBIT. Which is why we don't like finance people. Oops. Okay, well, mine aren't lined up anymore. So, okay, so these are just percentages, and these are rules of thumb. And I don't know if I talk about this. Generally, the larger the company, the lower the percentage. Did I talk about that before? Let me. Here, okay, so let's say we had total assets of 6 billion for company A and 600,000 for company B. And what percentage would you probably use? It's a judgment call. Oh, okay, so let's say we have total assets. We have 0.25% to 2% would be our rule of thumb, and that would give us our materiality level. Okay, so let's say that the I'm just making this up. Well, this is a big company, but it's not a massive company. So let's say that it's 0.5%. So this might be 0.005. Now, a smaller company, you can allow for that to be a higher percent. Let's say this is 0.2. Let's say this is, this is here. Why? Well, you'll see when we multiply these out. Okay. So 1% would be 6 million, so this is about 3 million. Uh, 2% of that would be, well, 1% would be 6,000, so it would be what, 12,000? So here's why you generally held the bigger companies to a smaller percentage than a smaller company. Bigger companies, at some point, the dollars become so large, you'd hate to go into court and say, oh, we weren't looking for a $3 million error. Depending on the size of the company. So the problem with larger companies is that the dollar amounts you're dealing with are just huge. So you generally use a smaller percentage as for what you deal with in materiality. Go to a smaller company. Even though it's 2%, we're using, the percentage we use for the small company is basically 4 times the size of company A. We're allowing for 4 times the error relative to total assets. However, it's only $12,000. No one's going to sue you for $12,000. A lawsuit would cost more than $12,000. So generally speaking, when you look at these percentages, for instance, this 3%, this is for large companies. What do you do down here? So the smaller percentage will be for large companies. The larger percentage will be for small companies. And again, the reason because that, for small companies, even being off by a higher percentage, the amount that it's going to be off by probably isn't that much. Okay. Performance materiality. This is the new term. This relates to specific accounts. And these are the, so this is for specific accounts. Tolerable misstatement is sort of the old term. Hey. Wait, I make a mess out of this. All right. It's kind of the old term, but it's also the term that's used for statistics usually. But it's account specific. So, for example, accounts receivable. So I still accounts receivable, but how much are you going to allow for accounts receivable to be off by? Well, usually it's based on the total materiality and what they're going to be off by. The book uses 50% of the total materiality for any account. That I would say that's probably not used by most firms. So for instance, if let's say company B here, that you would allow for them to be off by $6,000. So take 1/2 of that. And for any account, they could be off by $6,000. In total, they can't be off by more than 12. Or for up here, it'd be off by $1.5 million. In total, it can't be off by more than $3 million. They usually assign it a little more specifically. Not all accounts are the same. For instance, if you had an account, for instance, like depreciation. A, it doesn't have any cash. There's no cash to it. And B, it's an estimate. Not only is it an estimate, it's got 2 estimates at least. How many years usually, and what the residual value is going to be. So, depreciation being off is not as big a deal as, say, cash being off, or as big as inventory being off. It's not necessarily expected to be, as tight of it. So you might have a much lower materiality for, say, cash. Say, okay, cash has to be, right in there. and a larger one for something like depreciation. You may also have a larger one for, say, inventory. So much stuff can go, inventory is really hard. I mean, it's big. And there's two things going on in inventory. You have the count and you have the price. And so, you might allow for more leeway in that account than, say, the cash account. The cash account for smaller places, especially the cash account, should be 100%. You shouldn't allow for any error in it. So anyway, that's now in the book again, they would say use half of it as your tolerable misstatement or your performance materiality. Use half of it. That's kind of their rule of thumb, but usually it's more account specific, that certain accounts you allow for more leeway than other accounts, just because of the nature of the account. Okay. So this is for specific accounts. All right, I'm going to put this on the next page so we can look at it all together. And this, they really beat up a lot on the exam. Qualitative materiality. In other words, the nature of the misstatement. So a misstatement that is monetarily immaterial may become qualitatively material following this condition exists. There's other ones too, but these are this covers most of it. So if you have what would normally be an immaterial misstatement, it doesn't meet the standards, say up here. It doesn't meet those as being material. It could be material. It still could be material if some of these things, if it results in some of these things here, reverses a trend. So maybe a company's sales were increasing every year since they, our sales have increased every year for the last 50 years. Okay, they're going to decrease this year. So they misstate the sales immaterially, but so that they show an increase. Well, that might make that material. That might make it material. So even though the dollar amount might not be material, maybe the dollar amount is whatever is underneath that materiality amount. It's material because it reverses a trend. It says, okay, no, this is your sales have gone down for the first time in 50 years. This is significant. Sales aren't always increasing. If it flips from, let's say, a loss to income, we're going to show a loss, a little bit of a loss. Okay, well, let's goose the books a little bit just to show we're profitable. Well, the difference between a company that's profitable and a company that's not profitable is significant. Even though it might not be dollar-wise that big of a difference. One of my best definitions of an income statement is a small difference between two very large numbers. You get these huge revenues, huge expenses, and then a little bit that's in between those two, that's your income. So while the the actual difference between being at a loss or having showing profit might be small, it still is significant because a company that's losing money is different than the company that's making money. If it's management fraud, it's one thing if somebody's doing fraud that isn't in management. You got somebody who's I don't know, a shipping supervisor or a shipping clerk or something that's stealing inventory of 30,000 a year. If that amount is immaterial, it's not that big a deal. If it's the chief operating officer that's stealing 30,000 of inventory, that is a big deal because that reflects on management, the integrity of management. So if management's involved, it might make amount that is normally immaterial to being material. Okay, violation of a contract or banking agreement. So, for instance, a lot of times banking agreements will say that they can't get lending from any other place. That if you work for, if you get a loan from the First Bank of wherever, the First Bank of Chicago. I don't know if there is a First Bank of Chicago, but if there is, say you kind of, you're doing your banking with First Bank in Chicago. First Bank in Chicago usually says, look, you cannot get loans from anyone else. Why? Because we loaned you this money and we don't want you to become any more riskier without our knowledge by getting a bunch of loans from other places. Okay, so your client goes and gets a loan from another bank, a new material loan, maybe it's not very big. You get a loan for a piece of equipment or something. Even though it's not material, if it violates a contract, notice that the bank will probably be relying on that agreement, to see if they're in violation of the contract. When they read the financial statements, they want to know, is there any other lenders out there? And even if it's not material, it needs to be in there because it is a violation of the contract. Anything that increases management's compensation. So if they're doing this, if our sales hit this number, we'll all get bonuses. So they bump it up a little bit. It's not material, but they get their bonuses. That's also makes it material. If they do it to meet an analyst expectation or the client's public expectation. So if the client says we're going to, our earnings per share is going to be this, or the analyst wants it to be earnings per share to be this number. If you change the books a little bit immaterial to meet those expectations, that could be material. Acts that are felonies, things like bribes, insurance fraud, those sorts of things. Violations of the Foreign Corrupt Practices Act. Those are also things that could be. Now, just like material things that are dollar amounts, you hope that the client will react appropriately. Just like if they came up, if the company B had an error of 25,000, you bring it to them and say, look, you got to correct this. This is a $25,000 error. You make the appropriate adjustments to your books, to the financial statements. You hope that they do it. That's the whole point of the audit, is that they will actually change it. Same thing down here. Even if there's things like that are illegal acts, hopefully when management, if they're notified of it, will react appropriately and take appropriate steps to get counsel, go to the police or whatever they need to do. So not that any of these generally are unreconcilable. For the most part, if management changes what they're doing, changes the amount or whatever that is, if it's management fraud, if they take appropriate actions against people that are doing these kinds of things, that would mitigate it, and that it could be that it's not material. And you hope that they do that. You hope that when they, when those things are discovered, that management acts appropriately. It's impossible to have a company that nobody will ever do anything bad. That's not the problem. Is what happens when they do something bad. Okay. Yeah. How much more do we have here? Not too much. Yeah, we'll push through here. This shouldn't take too much longer. Okay. Consider multiple locations. That's not too much to talk about there. If they have more than one location, there's possible that there's interactions between the locations. And you might have to kind of isolate an operation if there's a lot of going in and out. And but for the most part, that's kind of normal for an audit. Assess the need for a specialist. We already talked about that. Consider the client's possible violations of laws and regulations. Okay, now, violations that directly impact the financial statements are more important than ones that indirectly. So, for instance, tax fraud. directly impacts the financial statements. If they're not paying what they should be paying in taxes, the tax expense is going to be incorrect on the financial statements. So those laws that directly impact the financial statements are more important. Violations that indirectly impact financial statements. EPA violations. So EPA violations, this might be that they are told they have to clean up an area or do whatever it is, stop doing this or whatever it is. They may have an impact on the financial statements, but it's not direct. It's not a one-to-one that you get from, say, a tax fraud. It might be indirect, that in the future they get fined or it costs money to clean up a site or something like that, but it's not a direct one-to-one that you'd get from, say, a problem with the taxes. So this is usually less important. And those that are directly impacted. And again, materiality, that's not so important. Always, when you look at these things, you're looking for things that are material. The liquid paper stuff, the whiteout, it's flammable, or it used to be anyways. And so if you had one sitting on your desk, it was fine. But if you had a box of it, it was considered a hazardous material to blow up. I seriously doubt it would ever got written up for having a box of whiteout. Even though it's a hazardous material, and they may not have been following the hazardous material rules. It certainly isn't material. Related parties are those people that will have an influence over the company. Say client. And related party transactions. Do not need to be at arm's length. Which is another way of saying, on the up and up, a fair price. In fact, unless they have specific proof, companies cannot say that related party transactions were done at a fair price or at arm's length. If they're done at a fair price or arm's length, why would you even do it? If the land is worth $150,000, why wouldn't you just sell it to somebody else rather than the controller or whoever? Okay. Document everything basically. Kind of goes without saying. We talked a little bit about this. Okay, I'm almost about to be talking about all of these. Testing controls. How do you test the controls? Any one of these. Ask employees, when you do this, what do you do? How do you approve this? How does this get sent to the customer or whatever? Inspection of documents. Are these signed? Are these approved by other people? That sort of thing. Observation. I really like that. When I was in auditing, that's what I did a lot of, because people will tell you, you can ask them about it, and they'll tell you a certain way. Sometimes you can read about it, read their controls or whatever, and they'll say that they do things a certain way. And then you go watch them, they're doing something completely different. I can't tell you how many times that's happened. It happens so often that usually by the time I audited for like 3 years, but like my last year of auditing, I wouldn't even ask them. I would just go watch them and then go ask them, questions about it. And not because of necessarily being bad. Sometimes they honestly thought that it was done differently. You talk to a supervisor, how's this done? Oh, this, and you go look at it, it's completely different. You go back and go, oh, I didn't know we did it that way. Oh, I thought we were still doing it like this. Walkthroughs, tracing a transaction from the original to all the way to the financial statements. You kind of look at the details of source documents into usually the special journals, and then into the general ledger, into the financial statements, kind of walking it through the entire thing. Reperformance of the control. I've done it. I did it a few times. The funniest one I ever did was restocking inventory at a warehouse. And they had this huge thing, that crane that goes up. These things were 40 feet in the air, and you'd have this lift thing that you lift you up. And in case you're wondering, those things are incredibly scary. When you get up, you get about 25 feet off the ground. This little tiny little cage thing that's all wobbly. You're trying to put parts in the bin. So anyway, I did that though, because there was a problem with restocking the inventory that wasn't getting recorded. And so my supervisor said, "Okay, go do it. Go do restocking." Okay, and the place had a union, so I was kind of hoping the union would say, "No, you can't do that. That's that's your management. You can't do that. We have to. That's a union job." Yeah, go ahead. Darn it. Substantive tests, test of details, transactions and balances, and substantive tests, substantive analytical tests. This is the weird one. These are analytical procedures are not usually proof of anything. There are the only one of the few things I can think of is, for example, the industry average for uncollectible accounts. So that's one of the few things that sometimes people will refer to as a substantive. It's an analytical procedure, based on basically ratios, 2%, 3%, or whatever it is, that you may have that as, compare that to the company. So if the customers that your client has are similar to those across the industry, you might use the industry average for uncollectible accounts as an appropriate estimate. So this is one of those things that it could possibly be an analytical, but generally speaking, analytical procedures are not substantive. You can't look at, for instance, if sales went up by 20%, that might seem unusual, but doesn't necessarily mean that there's fraud. It could be fraud. You look into it because it might be more likely, but generally speaking, analytical procedures are not evidence. Okay, I think that's it. Yay, we're done with that. Okay, so here's what we're going to do next. I think as we go on break, stop. As we go on break, I'm going to put up the poll, and I think we did the multiple choice questions for the sampling overview thing. Okay, so let me I'm going to actually pull up the sampling overview multiple choice. So this thing. And I will put the poll up. Poll. Launch polling. So I think you guys have already done this. I gave it to you guys last week, I think. So for question, 1 through 10, put in whatever you got for that, and we will we come back. We will go over the poll. Oops. Okay, who's we only have one person entering stuff. Okay,
Okay, sorry.
no problem. All right. I'm gonna, while you guys are finishing that up, I'm gonna go ahead and okay, I'm gonna assign two problems out of the book. Chapter 3. And let me camera over here. Okay, the two problems I'm going to assign are just that quick. I lost it. Hold on. 3-30, and then the text. These are textbook problems. And 3-31. And these are going to use those rules of thumb. They're in the textbook. They're also in the Chapter 3 handout. So then let me pull it up. So for those two problems, you're going to use these estimates of, you know, what is material and what's not for those problems. So they're actually, we were going to work out the quantitative and one of them actually has a qualitative part to it, but so these are what you're going to use for it, and you're going to use your judgment as far as what I'm not going to tell you which one to use. It's you know, if they're medium-sized companies, you go somewhere in the middle. If they're small companies, go to the higher end. If they're large companies, go here. So I'll leave that up to you guys to figure out. And it's a judgment call. You know, that's all part of it. If you're really stuck on one, let me know, and I'll see what guidance I can give you. I can't give you the answer, but because the answer is just really dependent on what you guys use for these. So yeah, so problem 330 and 331. I'm not sure. I closed out of it already. Okay, anyone still entering on the polls? Yeah, so this one, if you look in the handout number 9, it's also in your textbook. I lifted that right from the textbook. Okay. Well, Jason and Rama, let's see, I think. Let me check and make sure. Up through number 6, everything's okay. Let's see here.
Professor, I have a question on number 2.
Okay. Let me look real quick here. These are all correct. Yes, number 2.
So, I mean, I think it's attributes B, but stratified sampling, can you just refresh my memory on?
Stratified sampling is a part of, it's actually variable sampling, the same as down here. It's used to, for instance, anything over you take the sample and you stratify. So anything over, say, $10,000, you test 100%. Anything $1,000 to 10,000, you sample 30%. Anything other, so you take a sample. I'll do it right on here. So
yeah, no, I remember that. So what's confusing to me is because this is looking at invoices, and that happened to be the same example where we said take larger invoices or smaller invoices.
right.
In this particular, because he's trying to compare it to industry-wide.
Well, this is looking for a deviation rate. This is not looking for a dollar amount.
Oh.
So this is purely looking for, you know, are there billing errors? Yes or no? So this would be tested controlled.
Error, yes or no.
Yep. Yeah. So this is a attribute sampling, or generally the only thing we do for attribute sampling is test the controls. So are the billings correct? Now you could also do dual testing with this, that while you're checking for the billing errors, you could also write down, you know, the correct amount and use that in your substantive testing. But if you're looking for a deviation rate, this is only going to be for test the controls, is going to be for yes, no. But you guys got everything. First of all, you matched. And secondly, you got it all correct. And you know, the kind of wild thing about that a little bit is I gave a similar one to this. You had a couple things different in my other class, my introduction to auditing, and they had a very similar handout and stuff, but they were all over the place. It's tough. It's tough to do some of these. You know, think about the sampling and all that. Okay. Well, so here's what we'll do for next week. All right, guys. So I will add extra credit points onto your scores. Jason Ramo. So for next week, do the two problems. These two. And also do the multiple choice. And I think maybe we'll do those near the beginning of class. There's the chapter 3 multiple choice. I think there's 20 questions. And we'll do those in class, and you have the ability to get extra credit points on those on the test. And then next week, we'll talk about the problems a little bit, and then we'll also go over the multiple choice questions, and probably start on chapter 4. And then I'll also send out next week will be the chapter 3 exam. And let me look to make sure that I am clear about what we're doing. Chapter 4 risk assessment. I think I'm going to skip that. I'll take a look at it and see if there's anything that we definitely need on it. And if I do, I'll go over it next week. But
do you want us to turn anything in on these questions or anything, or it was fine that we just submitted it through the website?
Oh no! I take it from the website what you just did. No, you I'll put it in the extra credit for you guys. You don't need to turn anything else in. So whoever participates gets the points. So I got it written down here, and I will enter that into Blackboard momentarily. But it's actually going to be in a hidden. I guess I could put it. It doesn't have to be hidden. I could put it so it's available. But it'll just be a column that says extra credit, and it won't have anything in it until it gets assigned to the exam. It won't be applied to anything until we take the exam on statistics. Yeah. So next week, I'll take a look at chapter 4. I don't think there's much in there that we're gonna probably be doing, but I do want to get to the internal controls. That's chapter 7, and internal controls in general are 6 and 7 are generally the hardest part in auditing, and then they also have there's quite a bit of the questions are on it. They really beat up internal controls on the exam, on the CPA exam. So the more we do there, the better. Yep. So I got you guys in, and so for next week we'll do the multiple choice, do the 2 problems, and then I'll give you the exam. And we'll be on to chapter 7. If there's any, I'll take a look right now actually and see if there's anything. I don't think there's a lot in chapter 4 as far as the risk assessment. The biggest part is what I just told you there, and if they have more than that, then that's more than it's on the CPA exam in general. But I'll take a look at it. So the multiple choice questions and the 2 problems, and we'll go over those and start in on internal controls. All right. Okay. Well, here you want me, I'll tell you what. Here, let's see here. Can I publish this? So there's results. And so what, yeah, and then it will, there'll be a record of it right here in the video of it. So that is that's what you guys got. Any questions on that? Okay. Well, so with that, for next week, chapter 3 stuff, done with chapter 3. If I need to add anything for chapter 4, I'll put it in. We'll talk about it next week. But more than likely, we'll just start right in on chapter 7. Or 6. I'm sorry, I said something wrong here. 6 and 7. Okay. Question? All right. Well, no questions, and I will talk to you guys next week. Or I have office hours on Friday. I think I told you guys that I can't remember what I told you guys, but I think I told you guys on Friday that I was going to have to move the office hours up from noon, but I will not. They will be at noon and 6 p.m. So the office hours will be exactly the same. But if you want to talk any other time, that's fine too. All right, now I got to go try to craft a couple emails to the student trapped in Myanmar. And, oh man, all the crazy things. Okay, guys, have a good evening.
You too.
Yeah.
Thank you.
Good night.